This week sees the latest FOMC meeting with Jay Powell and co. expected to leave rates steady and essentially push the decision down to September. Now, markets do expect to see a rate cut in September, and so this could provide the groundwork for them to kickstart their easing process once again. Will Jerome Powell stay in the job until May? That remains to be seen, but certainly if he does start to cut rates after this meeting, it could save him from the chop as Donald Trump looms large. So essentially what we're looking at for this meeting is a pause. And you can see that once again here, 97% pricing under the CME Group's FedWatch tool for it to essentially be a damp squib, right? So rates remain as is. And that stands to good reason, because it's not long after that we see, just 2 days later, the 1st of August. And the 1st of August, of course, is that tariff deadline. The tariff deadline potentially bringing a sharp surge in terms of inflation pressures. And of course, the Federal Reserve has two things it needs to look out for: inflation and jobs growth or unemployment. So if one of them kind of goes off kilter, then they need to potentially step in. Well, that's not necessarily the case at the moment. And the question mark here is, will we see inflation rear its head once again? That still remains to be a key question. But the fact of the matter is, Donald Trump is doing a lot to try and stave off some of those fears. Now, the US-EU trade deal that has emerged over the course of the weekend is one part of that, one of the biggest trade partners that the US has. 15% tariffs on imports coming from the European Union, and then you've got packages of, say, $600 billion of EU money supposedly being invested into the US, 750 billion going into US energy imports, essentially, or exports into the EU, depending on how you're looking at it. So that is just another box that's being ticked off. Now, in my mind, markets are hesitant around what the Federal Reserve might do, because no one really knows what's going to happen in the future. And so it's unlikely the Federal Reserve are really going to be able to lay out a solid groundwork. Now, as long as we see these trade deals announced, it does essentially provide the groundwork for the likes of Jerome Powell and alike to be able to make decisions, right? They can't really cut rates in the face of a prospective spike of 50% tariffs around the corner. But each time we see those tariffs drop down, it does allow them to potentially think of essentially looking beyond those tariffs. So let's say, for instance, you have the threat of 30%, 50% tariffs. The Fed doesn't do anything. That's where we've been recently. But once we see them say, okay, it's going to be 15% here, 10% there, 15 here, 19% there, that is a tariff, and it could be inflationary by nature. But many within the Federal Reserve have said they're willing to look beyond short-term one-off inflation associated with policy to be able to look into the future and say that's going to drop out, and therefore we will still be able to do what's right by the economy. They just need to add greater certainty, and that is something that we're gradually starting to see. And as we can see here, there is an expectation for the September meeting that we will see a rate cut, 62% chance of a 25 basis point cut, and a very small outside 2% chance for a 50 basis point cut over the course of the next two meetings. So the question mark for markets on this occasion will likely be around whether we're going to see a cut in September. Are we going to see a secondary cut at the back end of the year? And that's what markets are currently pricing, another December cut as well. So 2 cuts for the remainder of this year. And with the fact that we're seeing additional information provided to us in terms of what the state of play will be in terms of tariffs, it does at least provide the likes of Jay Powell and co. with the ability to say to markets, look, if we see 15, 19, 10% tariffs on all of these countries, and we don't have the possibility of a massive spike in terms of tariffs, that at least provides us with the basis to be able to say, even if we see a small uptick over the near term in terms of inflation, we're willing to look beyond that. But until they've actually provided that security or that stability, it's unlikely we're going to see the Fed actually doing that. Now, part of the concern has been around the idea that we could see inflation start to rear its head once again as businesses pay more for goods coming into the country. And that raises the question of who's paying for the tariffs. Is it the exporter from the foreign country essentially having to drop their price? Is it the importer? Perhaps, let's say Nike decide to buy a trainer from a manufacturer abroad. Well, they could get it cheaper from the manufacturer, or they just end up having to wear that additional cost and their margins are smaller, and therefore that would hurt the share price. Or else it could be the consumer. They just pass that additional cost on for that input to the end consumer, and that raises inflation. So 3 different places it could potentially be. Of course, the best case scenario from the US is that the foreign company essentially drops their price by, say, 15%. But that's not necessarily likely to be the entire story. And so instead, we're going to have to wait and see exactly how inflation rears its head. We're starting to tentatively see some signs that inflation is starting to pick up in some key areas, notably from China. Remember, China is the 12th of August is the deadline, but that could be pushed by another 90 days, according to rumors that we're seeing in the markets at the moment. So yeah, there's a risk of inflation over the near term, but for markets, they need to know, if we do have greater clarity over the direction for tariffs and the state of play, but inflation rears its head a little bit because of that, say 10 to 15% tariff, will you still continue to ease despite that? That's the key question here for markets, despite the fact that some of these manufacturing surveys do provide the basis for a potential uptick in terms of inflation. In terms of how markets are going to be trading this, we just basically look in terms of like how is this rate decision adjusting market expectations? Is it going to make us think we're going to see more rate cuts, so earlier rate cuts, or more rate cuts this year, or less? And therefore, we look at the relationships between the expectations of interest rates by year end. That's what we're using at the moment, year end, and then overlaying that against different markets, seeing exactly how markets are treating those adjustments over the near term. So let's kick off with gold. Gold has essentially done well during periods of expectations of higher easing, but poorly during periods where we actually think that the Federal Reserve will hold off. That's perhaps why we've seen gold largely sideways for a while now, because markets are increasingly concerned that we're just going to keep pushing back the rate cuts until we see greater clarity from the likes of Donald Trump and in terms of the tariffs. So what this means is that if we do see a meeting where they really spell out the fact that we're willing to move in a very decisive manner, if we see greater clarity over tariffs, and even if we see an uptick over the near term, we're willing to look beyond that, as long as we don't have the uncertainty associated with the possibility of really high levels of tariffs. If that comes into play, then that could provide the basis for strength for gold, as people expect additional easing from the Federal Reserve. Let's jump into the chart as a result. This is the chart for gold over the weekly time frame. You can see this consolidation that's been taken hold, and it's continuing apace. Like, bearing in mind that these trade deals also sort of negate part of the reason why people were very bullish gold, and that is that essentially with the breakdown of relations between the US and many of their sort of trade partners around the world, it means people sort of move away from US treasuries and instead start heading into something like gold. So if we do see trade agreements, so a sort of closer ties between these countries, then you have the possibility that people don't necessarily need to jump into gold in the same way as they had previously. That's certainly the perception. So part of why when you see these trade agreements coming into play, you often see gold suffering as a result. Like I said, if we see a particularly dovish statement for this meeting, possibly we see a sort of resurgence from here. But for me, I think we're moving towards a period where sort of those tariff concerns are really easing quite significantly. So that could sort of keep a lid on gold prices. Markets are currently pricing 2 rate cuts for the back end of this year. I think that's pretty healthy. I mean, okay, you could potentially get 3, but, I don't think that's necessarily likely. So, the question mark here is, are we going to see something super dovish from the Fed that's going to shift the market perception quite significantly in the direction of more rate cuts? Not necessarily hugely convinced. So personally, I think we could move into a phase where, we possibly sort of not necessarily range bound, because we're not ranging here, but, I just think that we could see more of the same, which is in essence a lot of consolidation. You can see the sort of lows down here where we've got a low here, here. So that sort of 3250 kind of area looks interesting for me. We're selling off at the moment. I don't necessarily think we're going to see a massive top for this market, but if we start to break through those support levels, given the fact that we're breaking through trendline support, then there is the risk of a wider pullback coming into play. Keep an eye out on the US dollar as well, which is something that we're going to talk about now, because of course we've been seeing significant dollar weakness. What happens if the dollar potentially strengthens? Could that also hinder sentiment around gold? That's definitely one to be watching out for. Next up, we're going to be talking about the US dollar, like I said. And so essentially what we're looking at here is that the US dollar has been sort of inverted the dollar on this occasion. So essentially up is down and down is up. So treat this like euro dollar, right? Yeah. And mixing axes. It's a bit confusing, but I'll try to do my best to explain it. So additional rate cuts have been leading to weaker price action in terms of the US dollar. But by and large, even at periods where we're not necessarily seeing a massive amount of movement in the opposite direction, we're seeing quite significant weakness for the US dollar. A lot of it is being tied up with the sentiment around the trade war. So yes, if we suddenly see a move towards a sharp decline in terms of US rates, it could possibly drive the US dollar lower. But a lot of it, I think, is also tied up into whether we do see these trade deals reached or not, and the perception around global demand for the US dollar as a result. Now, in terms of the chart for the dollar index, this is the monthly time frame. What you can see here is that essentially you've got this area of support coming into play here, right? So the wider trend does point towards a possibility of the bulls coming back into play. And with each trade deal that comes into the fore, you see increased possibility that the dollar could be potentially bottoming out. Of course, the caveat is many central banks, the likes of the ECB, could soon move into a phase where they stop cutting rates. And the Federal Reserve pretty much is only just starting. So that provides the basis for US dollar weakness. So I think there's a possibility of a sort of near-term bounce coming into play as trade deals are agreed. And at the back end of the year, that's when you start to see some more sort of weakness coming in for the US dollar as you see those interest rate differentials coming into play. So looking out for this over the near term, you can see we've got a prospective sort of bottom coming into play around trendline support with a rally up through, there we go, 98,496, providing greater confidence of a near-term sort of rebound. I don't necessarily think that rebound is going to suddenly recover everything from before. I think it will not be short-term, but sort of medium-term in nature if that comes into the fore. But certainly, like I said, if a lot of it comes down to sentiment for this meeting, are we going to see them coming out with something really dovish, or are they just going to continue to be sort of relatively cautious in nature, given the fact that, these deals do all have a bunch of tariffs associated with them, and that can bring inflation. So that's a key market to be looking out for at the moment, because I think that US dollar story has really been playing out in such a consistent manner, and these things don't last forever. So I'll be interested to see whether that is a bottom, whether the bears are just going to continue apace. And finally, on the S&P 500 front, essentially, let's see. So we've got the S&P 500, which is straight up. Then we've got interest rate expectations, which are on the right-hand side. So essentially, the lower the green line is, the more rate cuts we're expecting. So essentially, we've seen this divergence where in the past, if you see additional rate cuts coming into play, that to markets means that we're expecting a recession, right? So markets didn't particularly like that. So recession fears sort of overshadowed the idea of like, oh, great, we're going to get a rate cut, but it comes at the expense of having the economy sort of significantly turning lower. Things have kind of diverged a bit since then. So markets aren't really so concerned about recession anymore. And in which case we're now seeing sort of divergent movements between expectations for interest rate cuts and the movement of the likes of the S&P 500 that we've got here. So to me, I think we're now moving into a phase where rate cuts are going to be seen as a positive rather than a negative for equity markets, because they're not backed up by recessions, essentially by recession fears. Instead, it's like we've got a strong economy. If the Federal Reserve wants to step in, even better. So that's kind of how I see it, despite how the relationship has kind of adjusted over the course of this chart. It's kind of gone in and out and in, and it's interesting. But the stock market certainly at the moment feeling pretty positive, especially given the fact that the US economy appears to be holding up relatively well according to some of the recent data points. Now, let's just top things off with the chart for, let's just see what we've got here. So let me just quickly bring up the final chart, which will be the Nasdaq on this occasion. And Nasdaq's kind of at the forefront of everything at the moment. So big tech earnings over the course of the week. I thought this would be an interesting one to be looking out for. Excuse me, I haven't actually got it added there. Remove. Having a mare. There we go. Right. So this is the Nasdaq, the daily time frame. You can see here that we're just going up and up and up. The trend is definitely your friend on this chart. And so it's a case of just like looking out for these lows, right? So swing lows coming into play, you know, keep seeing these sort of stepped move higher. That's exactly what we want. We're seeing a little bit of weakness, then it rallies again. So if we roll over, the question mark is, do we break the 22953? I don't necessarily think so. The trend is very much clearly defined at the moment. So this is very clearly a nice bullish market that we're trading within. If we see a particularly dovish statement coming out from the Fed, I think that this market will really celebrate that. If we see them coming out of a relatively cautious tone, I don't necessarily think it's going to dramatically lead to a massive sell-off here for the Nasdaq. But like I said, if we do sell off, for me, the bulls are likely to remain in charge unless we see the 22953 level broken for the Nasdaq. I hope that's all been useful for you guys. It's going to be a massive week. Quite frankly, I'll do another video also about the core PCE price index, the inflation gauge later in the week. But this has been the wrap up for how I see things from the FOMC perspective taking place on Wednesday evening. A big week in terms of earnings as well. Be careful. Lots of opportunities, lots of risks as well. Risk management, definitely key. I hope this has been useful. Again, like, subscribe, follow. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day. Good luck trading. Thank you.